Has anyone ever told you that you should start investing but you had no idea where to begin? That was me when I started as well. My friends were all downloading Robinhood and talking about stops and puts, and I had a huge sense of FOMO. So I took my savings, opened a brokerage account, and started trading, only to be filled with anxiety day by day as the market went up, down, and sideways, and in this process, losing a not so small amount of money. Don't be like this guy. It's true, there's an almost overwhelming amount of investment options out there, with people seeming to speak an entirely different language. But in this video, I'm going to break it down for you in a simple step-by-step guide on how to get started on your investment journey, the smart way, inspired by J.L. Collins' The Simple Path to Wealth. In Collins' essays, he lays out all the lessons he's learned from all the mistakes that he had made during his 40 years of investing and highlights a truly simple path for the average person to build wealth for themselves and their family. Hi, if you're new to the channel, my name is Dr. Dang, the financial neurologist. I'm a board-certified physician turned financial nerd, and together we'll take a look at how your brain influences your personal finance. Before we get started, I want to highlight that I am not a financial professional. This video is for educational and entertainment purposes only. You must conduct your own research and know that all investments involve some form of risk, and there's no guarantee that you'll be successful in making, saving, or investing money, nor is there any guarantee that you won't experience any loss in investing. Always remember to make smart decisions and do your own research. With that out of the way, let's get into it. Investing step number 1. First, some background. There's been a mountain of research that has piled up since 1976, since the creation of the very first publicly traded index fund, the Vanguard 500 Index Fund by Jack Bogle, that continued to prove definitively that not only do index funds work, they are vastly superior to any other investment method out there, outperforming more than 95% of actively managed funds. When anyone tells you that index fund investing is lazy and settling for average, tell them they're lazy for not doing the actual research. Oh, and let them know that top 5th percentile performance is not exactly average. If I was top 5th percentile in medical school, I'd probably be up in my ivory tower neurosurgical power suite, eating my caviar and sipping champagne on my private yacht. Okay, rant over. So hopefully now that I have your attention, let's see how we can get started investing today. First, let's start with some primers on index funds. So an S&P 500 index fund is a fund that tracks and allows you to invest broadly in the 500 largest publicly traded US companies. And a total stock index fund tracks and allows you to invest in all publicly traded US companies. And a total international stock index fund allows you to invest in developed as well as emerging economies. This terminology also applies to index funds that track bonds. In addition, we'll mention expense ratios, which represents how much in fees are being charged to manage your accounts. For example, an expense ratio of 0.04% would mean that if you had $10,000 invested, you pay your brokerage company $4 per year to manage your account. Investing step number 2, open an account and choose an asset allocation. So the first step is simple. You go to your favorite brokerage account website and click open an account. Do this right now. This could be with either the top 3 brokerage companies, Vanguard, Fidelity, or Charles Schwab. My personal favorite, as well as J.L. Collins, is Vanguard, mainly because when Jack Bogle founded Vanguard in 1975, he did with the intent that Vanguard remain client-owned and is operated at cost. In contrast to how most other investment companies are structured, as privately owned family businesses like Fidelity or publicly traded companies owned by shareholders. In either case, unlike Vanguard, the shareholders or owners expect a return on their investment. Remember, the more fees that they take, the less the individual investors gets to keep. With that in mind, the investing landscape has changed considerably since low-cost index funds first came onto the scene, and to compete with Vanguard, many brokerage companies have now conceded to provide their own low-cost index fund options. So in the end, everybody wins. Next step, determine your recommended stock to bond allocation. To do this, you could subtract your current age from 120, then use this number to represent the percentage of your portfolio that should be in stock, and the remainder should be invested in bonds. This comes from the concept of the efficient frontier by Harry Markowitz, which illustrates the optimal mix of assets that offer the highest expected return for a given level of risk. This research laid the groundwork for understanding how to construct diversified portfolios to achieve specific risk-return objectives. This asset allocation strategy also leans on studies that examine the correlation between different asset classes, encouraging the combination of asset classes with low correlations to help reduce a portfolio's overall volatility when that is desired, like in retirement. Long-term historical data analysis has demonstrated that a portfolio's return is impacted the most by asset allocation decisions rather than individual security selection or market timing. Don't pick stocks, don't market time. Pay attention to your asset allocation. Finally, the easiest method I found is to choose a low-cost target date index fund, which is usually a basket of broad market index funds that automatically adjust the allocation between stocks and bonds as you approach your retirement age. They usually also consist of a total stock market index fund, a total bond market index fund, a total international stock market index fund, and a total international International Bond Market Index Fund. This is actually a strategy I use myself because I value simplicity and automation. Investing step number 3. Choose a fund. Okay, now to choose the index fund you'll be investing in. If you're with Vanguard, a good starting point is the Vanguard Total Stock Market Index Fund, also known as VTSAX. This fund tracks the CRSP US Total Market Index, which attempts to provide broad exposure to the entire US stock market, including large cap, mid cap, small cap, and micro cap stocks. You may notice that the composition of this fund looks oddly similar to the typical S&P 500 index fund, and you're not wrong. They essentially cover the same large cap companies and proportionally is made of the 500 largest US companies, but with additional coverage of mid to micro cap companies. Vanguard's Total Stock Market Index Fund has an expense ratio of 0.04%, one of the lowest rates in the industry. If you're with Fidelity, there's Fidelity's Total Market Index Fund, also known as FSKAX. This fund was founded in 1997 and tracks the Dow Jones US Total Stock Market Index and operates with an expense ratio of 0.015%, very low by any standard. Fidelity also started offering a new product called the Zero Total Market Index Fund, also known as FZROX, with a 0% expense ratio. But I don't recommend this one because there are restrictions in transferability as it does not support in-kind transfers to other brokerage accounts, something that I dealt with personally. Finally, if you're with Charles Schwab, you can go with Schwab Total Stock Market Index Fund, also known as SWTSX. Founded in 2018, this fund also tracks the Dow Jones US Total Stock Market Index with an expense ratio of 0.03%. As you can tell and possibly predict, the performance of these funds have been remarkably similar. Though you should never use past performance to choose your investments, I want to highlight that from 2012 to 2023, VTSAX, FSKAX, SWSX have all performed similarly at 12.8% returns per year. Remember the exercise earlier where we subtracted your age from 120? Now use this number as the percent to allocate to the stock index fund that you chose. For the remainder, you can invest in any total bond market index fund. If you're with Vanguard, I recommend the Vanguard Total Bond Market Index Fund, or VBTLX, which tracks the Bloomberg Barclays US Aggregate Float Adjusted Index with an expense ratio of 0.15%. You could be done here, but an argument could be made to have international stock market exposure as well, instead of entirely relying on the US economy. Though to be fair, the large cap companies that comprise the majority of the US total stock market index are in essence also international companies and represent 50% of the total world market valuation. History has shown that sometimes relying entirely on the economy of one particular country for your asset allocation could be exposing you to increased risk. For instance, in the early 1990s, the Japanese Nikkei market experienced a 60% collapse from its peak, with a period of economic stagnation lasting for more than a decade afterwards, and even today has not fully recovered to that initial peak. To account for this, some investors have exposure to international stock markets as well. If you're planning on investing with Vanguard, you have the option of the Vanguard Total International Stock Index Fund, also known as VTIAX. This fund tracks the FTSE Global All Cap Index, which represent developed as well as emerging markets proportionally by market cap, and is comprised of approximately 7,900 international companies with an expense ratio of 0.11%. This index fund does not duplicate the performance of VSTAX as it excludes all US companies, so it merely serves to complement the diversity of your current portfolio. Fidelity has a similar offering in the Fidelity Total International Index Fund, FTIHX, which tracks the MSCI All Country World Index, including the US market as well, with an expense ratio of 0.06%. Charles Schwab offers the Schwab International Index Fund, SWISX, which represents 21 developed markets with a focus on Europe and the Far East, but no emerging markets, with an expense ratio of 0.06%. You also may have noticed that I didn't go into ETFs, otherwise known as exchange traded funds, not because I don't think they have value, but because I believe that ETFs have been created to encourage active trading, and if you don't engage in this counterproductive activity, the differences over the long term between an ETF and a traditional index fund should be negligible. Investing step number 4, automate your investing. Each brokerage company has a feature where you can set up automatic transfers from your bank account to your brokerage account and have it automatically invested in the fund of your choice. A general rule of thumb is to invest at least 15% of your gross income with every paycheck. I know when you start off on your investment journey, 15% is a lot, and it's a little intimidating to sock that much money away without touching it. You can start off small with as little as $100 per pay period, whatever you're comfortable with. The important part here is to exercise that investing muscle to start now and build it into a regular, lifelong habit. Before we move on to the final point, I want to take a moment and take a step back to focus on the message I want you to take away from this. Don't overthink it. Don't let the idea that you need a ton of extra money or the perfect strategy to start investing. The important thing is to start now, automate it, and make it as regular a habit as drinking your morning coffee. Check into your accounts 2 or 3 times a year, but otherwise, leave it alone. Also, remember why we start investing, so that we can build a future for ourselves and our families. Investing step number 5, keep it simple. When I first started reading J.L. Collins' book, I was struck at the simplicity of it, especially after coming from reading something like Jack Bogle's book. This simplicity comes not from a lack of understanding of the economics behind investing. It comes from 4 decades of investing experience and mistakes he wholeheartedly admitted that he made during his own path. You really could build your wealth and a bright future for your family owning a single low-cost broad market index fund. Whether it's with Vanguard, Fidelity, or Charles Schwab, it's all versions of the same thing with almost identical historical performance. As you grow on your journey, you could learn a little bit more about different asset classes as well as tax strategies, but the number one thing to keep in mind is to not get lost in the details. To simply get started by opening an account today and set up regular automatic contributions. In the end, it's not necessarily your investment strategy that will take you towards your end goal, but your ability to save and to stay consistent, as well as to get started in the first place. Don't listen to your friends as they chase the latest meme stocks, and don't sell your portfolio when it's been a particularly bad year or decade in terms of speculative performance. As J.L. Collins would say, if your beer is the actual underlying business and the foam is the volatile speculative value of that business, don't try to market time your investments in the foam. Invest in the beer. Start investing now, contribute regularly, and stay the course. This is how you build your wealth. If you found value in these videos and want more useful financial insights, hit that subscribe button, tap the notification bell, and be a part of our journey. Stay tuned and keep thriving.